Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. We're recording this a little bit early on December 21st, 2023. S&P 500 currently sitting at 47.23. I'm David Zarling. I'm here with a reindeer nutritionist, Ian McMillan. Plenty to cover this week. I apologize that we're recording this early, but it's also nice to give our editors a week off. And so we're getting this done early. So we don't have Friday's information yet, the 22nd, but we should be able to suffice with what we have here today. But where would you like to start with anything that we're covering?
Yeah, for the most part, stocks continue to be pretty strong. I guess you can put bonds in that same category, crypto in that same category. Very, very strong uptrends. Continue off it was October, it's like late October. I think everything, and bonds kind of bottomed, peaked, rates kind of peaked, stocks bottomed.
That's a good point.
Dollars stopped going. It stopped going up at the end of September. But kind of a double top there at the end of October. It's been in a downtrend.
So you're saying the relationship between a poorly performing dollar and well-performing equity still remains?
Yeah, risk on bonds probably aren't as risk on high beta as, say, equities or cryptos.
Well, and wouldn't we potentially have an environment upon our hands, interest rates move in a 40-year cycle, and we're in a new cycle, a new 40-year period where interest rates are rising, that you would see bonds and stocks move together?
Yeah.
And now we're in we've talked on here in the past about rate of change as far as interest rates go, and just seeing rates stop climbing and pull back in, seeing bonds rise and stop dropping. We're seeing a cooling off in the rate of change of rates, which tends to be commensurate with what equities might be able to do. And speaking of rate of change, I know you've done some work on just the move we've seen since late October through now. Can you comment on that using something like the S&P 500, this move that we've seen and where it matches from, because we're market historians, what it looks like from history?
Yeah, certainly one of the strongest moves if you look back. It's about, I would say, like we're 38, 39 days off the lows from October, 39 trading days. And, up 14, 15%. And we really haven't seen that type of move. COVID, we had like a 25, 26% move. Rebound off the 2018 lows, right? We all remember Q4 2018, pretty brutal. The ensuing V bottom got back up above that 2600-ish level. That was also a pretty strong move in this same kind of realm of what we've seen. And then 2009, you had a very strong move off the lows. Probably the strongest. Yeah, that was like 30% in a month and lots of volatility back there. Also had similar move late in 1998, S&P breaking to new highs. So more of a similar situation. Right here, we had peaked in July earlier that year, ended up having a 24% drawdown, and then the rebound back to those highs was a pretty big move, and obviously went high for a few years later. Now the NASDAQ did much better but S&P did grind higher and really till late 2000, kind of a double top there. And
so you're talking late 90s, the bottoming process in 2009, and then I believe I heard you say off the COVID lows.
2019 COVID lows, 2009, 98.
Those are all jump-starting markets.
Some other thrusts down there that have counter trend moves that happened in 2000 to 2003. So there were some counter trend moves. We were below a 200-day. I'm not going to put that current environment in that category.
Got it. So we often talk about breadth thrusts on here, but what you're describing is a price thrust.
Very much so. Very much so.
And so here we have
move.
more evidence continues to stack up, whether it's a wig breath rust, Whaley breath rust. Last week, we talked about the rust that we saw, the price thrust that Ian's talking about, things being overbought. And as a reminder from last week, overbought's not a great term in the sense of if you're not in this industry or you're not a technician. Overbought has that sense of like, oh, it's gone too far. It really what it's describing is overwhelming demand. And so we have this scenario of overwhelming demand, institutions tripping over each other to acquire stocks.
And I think of all the similarities, that 1998 situation is the closest to what we have in price behavior today. Pretty nasty going into Q4. Pretty rough. In this instance, it was a September. We're below a 200-day. We get back above, and it was a quick move, much like you saw today. So if you want to extrapolate that, traded sideways for about a month, broke higher, actually December 22nd. So shout out to tomorrow, and trickled higher over the next year. Like I said earlier, obviously the NASDAQ had a much stronger move in 1999, but so we haven't got the sideways move. We're there. We have completed the cup portion. We'll see if we get a handle, or if it's a big double top, or
right.
We just keep going.
And what Ian's describing here is when we look across some important levels, horizontally speaking. So we always talk about potential areas of resistance. We'll call them horizontal levels. These are areas where sellers have shown up in the past, and we're there for multiple areas. You look at small caps using IWM. This 200 level is something that has been resistance going back to April of 2022. So sellers showed up in August of 22, February of 23, August of 23. We're back to that level now. When you look at the NASDAQ 100, similar resistance level from a big picture perspective as the S&P 500. So when we look at the NASDAQ 100, this 405 level is where the market correction began, and we're back there now. So this instrument hasn't gone anywhere for 2 years. S&P 500, similarly, 4800, 4805, a resistance level. And what Ian is talking about is the potential for a double top. He's not calling for that. It's just this is where you would kind of see that begin to manifest itself, that we can't get over these levels, or we get over them briefly and then move lower below them. That would be a warning sign. I don't want to put words in your mouth, Ian.
No.
These are important levels. Small caps 200, QQQ, NASDAQ 100, 405, S&P 500 cash, 4805. This is important. And you look at even high beta stocks using something like SPHB at 82. This is where you would expect some resistance to take place. This is where you expect sellers to show up. And it's interesting that this is happening right on the doorstep of the Santa Claus rally period, which I believe starts tomorrow.
It does start tomorrow. And then you get all next week, obviously minus Monday. And then you get January 2nd and 3rd, I believe.
Okay. So next week, Tuesday through Friday.
And then Tuesday, Wednesday.
And Tuesday, Wednesday of the new year. That's our Santa Claus rally period.
Yeah.
That right?
I hope we didn't blow up our money the last month.
Yeah. Well, it would be really important information if during the Santa Claus rally period, the period that Ian's talking about, that we didn't see an appreciation.
What happened this year?
This year, we were actually positive.
So it was positive.
Yes, it was positive. And we were up about 0.8%. And when you look at like the first 5, there's 3 seasonal periods coming up here that are worth paying attention to. One of them is the Santa Claus rally period.
We were up for January too.
And we were up for January. So then the next thing is the first 5 days of January. And then we look at the January barometer, which is January as a whole.
So we were 3 for 3.
We were 3 for 3.
And we had a good year.
And so the full year return was positive 93% of the time when that happens. 2023 matched that. Now heading into 2024, the Santa Claus rally period, which is the last 5 trading days, which begins tomorrow, plus the first 2 of the year. We want to look at the first 5 trading days of January, and we want to look at the January barometer, which is the full month of January. If all 3 of those are positive, 2024 could be another great year. It is an election year, and that has some electional seasonality to it, worth paying attention to.
It'll be real fun next summer.
Yeah, right. And that's what I think. Not that it matters what I think, but when you look at seasonal tendencies for election years, summertime of 2024 is notoriously volatile. And if you think about the move from the late October lows through now, we don't get to use the word parabolic because we're not at new highs. But if that trend were to continue all the way through January, let's say we're in a move in stocks that does become parabolic.
2018.
Right. You could have a corrective period somewhere in March and April of 2024 that looks a lot like June of 2020, or like you said, January of 2018, where you have this parabolic move to, because 2018 was not like today in the sense that it was ongoing new all-time highs. All of 2017 was new all-time highs. We're just there now. We haven't gone anywhere for 2 years.
That's true. That's a good point.
And so that's a major difference from a technical perspective, is this market hasn't done anything for 2 years. And we're just now getting to prior all-time highs in a lot of different measurements. If we clear that and move higher into January, February, and March at the same rate, first of all, that would be very impressive. I'm not calling for that. If it would, that typically doesn't correct sideways. It typically corrects with a more of a June 2020 type scenario or a January 2018 scenario. We ride sideways into the summer of 2024. The election happens, whoever your least favorite candidate wins, and then the market moves higher despite your biases. Typically how it works.
I hate that when that happens.
I'm with you. I love it when the market moves higher, but when it doesn't confirm your political bias. Yeah, that's what you're saying. Like,
I can't believe we're giving this dude an uptrend.
That's right.
Oh my gosh. Okay.
Right. And it does. It falls
like
on
this
both
guy
sides.
deserves a low volatility uptrend.
Yeah, not so much. So we'll see. We'll see.
Tis the hand we've been dealt.
Tends to be the way it works, and that's okay. So, Ian, we've kind of highlighted the price expansion, the breadth expansion. We're into these important horizontal levels, small caps using IWM 200, NASDAQ 100, QQQ 405, S&P 500, cash 4805, S&P high beta around 82. When we look at relationships, though, high beta versus low volatility, which tends to be broke out to a new high, that tends to be risk on behavior. The move from October through now, are we done?
Yeah, I have no idea. Staples hit a new relative low. So you got to put that in the bullish bucket.
Yeah. So you got high beta versus low vol moving to a new high, breaking out. You've got Staples, which is a risk off place where people like to hide when the market's correcting, doing the opposite, breaking to a new relative low.
Yesterday, we had a nasty day in the market. Utilities were the worst sector.
Yeah, utilities and staples.
Yeah.
And those are defensive areas. And to your point, yesterday, the 20th of December was the worst.
Yeah, that was rough. What did we say, 92% down day?
92% down day, 92%. And it also was, it was the largest down day we've had since basically the October low. Maybe you could argue November 9th, but it's not even, it pales a little bit. It's not quite the same. But one day doesn't make a trend. What we saw in late October was that flush. We saw panic selling turn into panic buying, this breadth expansion. Ian highlighted the price expansion. We've got high beta versus low vol making new highs. You've got something like staples relative to S&P making new lows. Meanwhile, you got the Dow Jones already at all-time highs and holding it. You got technology at all-time highs and holding. You got semiconductors at new all-time highs and holding it. I mean, as you said, Ian, things continue to
Home
fall into the
builders
post.
are there too, right? Did you say home builders?
I did not.
I think they're at all-time highs, right? They got to be.
They are, all-time highs. They had a very quick move. And home builders on a relative basis using the S&P, a massive base that they're breaking out of that goes back to 2008. You're talking about pretty large base. And from large bases come high spaces, something that many wouldn't necessarily predict in a quote-unquote higher interest rate environment.
Yeah.
And here we go. We've got home builders moving to new, let alone 52-week highs, but coming out of a base on a relative basis versus S&P. What else is worth noting on this episode?
I mean, so obviously great move out, from Russell trying to get out of this range that we've been in. We're back to the upper boundary, if you want to call it, 200, 201, 198 area, right? So this is our fourth trip up here since August of 2022, and still some work to do. Great move, but obviously, the laggard with the biggest hole to dig out of, but a great effort. Healthiest thing, I guess, here would be a consolidation.
A little digestion of the move.
Yep.
Because it is the fastest move from a 52-week low to a 52-week high.
Wow.
In small caps that we've ever seen. We are above
kind of thrusty, price thrust.
Yep, that is very thrusty. And we're above the volume weighted average price from the all-time highs in IWM. And now it's about clearing this 200 level. And the reason why we're harping on this is what's interesting about 2023 is that when you look at the return of the S&P 500, 71% of the S&P 500 underperformed the S&P itself. So when you think about that, and when you think about the Magnificent Seven, the really large cap names, the seven biggest in the S&P, carrying about 130, 140% of the return, it was a pretty narrow market in 2023. If we're going to see a broadening out, which I think is something you've highlighted here in the past, Ian, for 2024, is you could see this scenario where small caps outperform in 2024. The only way they do that, though, is if they're above 200 on something like IWM. That's just the simple math behind it.
Another area at all-time highs is aerospace defense. I guess it's okay on a relative basis. Not as strong as something like, you mentioned semis. Internet's pretty good.
Well, that's just it. Some of these places just have some room to run. And so is 2024 the catch-up trade? Because 2023 was pretty narrow. So we had wide dispersion. And so do we have a narrowing in the first quarter of 2023 where you have this massive run in small caps? And wouldn't it be interesting to look at a relative chart of energy versus S&P and using XLE versus S&P, where it is on a horizontal level is right where you would expect that relationship to pick back up? Doesn't have to. But if small caps are going to move above 200, you would probably see something like energy hold right here and become a leader again at the start of the year, along with regional banks, along with your biotechs. You'd see something like IBB clear 137, or if you want to XBI above 90. These would be important areas for those to clear for those areas in order to confirm that's, a broadening out of the market. Doesn't have to do that. We could continue to see in 2024 that it's narrow and it's the large cap. It is what it is. I guess we're not here to tell the market what to do. Anything else from a industry or sector perspective that's interesting to you, Ian, worth noting? Otherwise, we could shift to other asset classes and cover those if you'd like.
Other assets.
I think you mentioned bonds earlier. Bonds
continue to look good. Kind of coming into a rate of trend here, maybe. We'll see.
Okay. Are you talking about AGG or TLT?
TLT. Well, more so rates. We'll see.
10-year or 30-year?
30.
No, that's a good point. Rate of trend.
And the December lows.
We did break below 433 on the 30-year. And it could just be a matter of this is where we're going to consolidate for a little bit.
10-year looks a lot worse.
True story. A little bit more of a rollover. So with bonds and rates, bonds moving higher, rates moving lower, rate of change on those stabilizing, you see things like ICVT up against horizontal levels. What about something like the dollar?
Yeah, dollar, below 105. Probably in a downtrend once we're below 100, 99, 100. That's a pretty big area. 100 is a big area.
Yeah, it's an area we
Below
had a false breakdown below in July of last year. Well, that's where we saw stocks correct end of July into October of 2023. And that's what that's when you saw the dollar appreciate. So if we continue to see the dollar move lower,
should be a tailwind.
It should be a tailwind. Related to that, gold.
Yeah. Still just hanging out
at this 2000 level.
About it.
It reversed December 4th, pretty big reversal candle potential. It did move lower until, about a week ago, but we've since reclaimed the 2000 level and we're back above the close from that day.
We are.
And so 2000 above this 2050 level on gold could be significant. This goes back to opportunity costs, right, Ian? I mean, we can own gold, but is there a cost to it?
I mean, it almost made year-to-date relative lows the other day. So,
yeah, good point. You're saying tremendous opportunity costs.
I would say so.
Yeah.
Then you could own the old Bitcoins over gold.
Bitcoin. It's interesting. You can't go anywhere on social media without seeing a video about Bitcoin. So I don't know how you're going to ever measure when you're at a euphoric sentiment in Bitcoin, because the Bitcoin maximalists are always maximalists. They're the new gold bug. Like Bitcoiners, people who love Bitcoin are the new gold bugs. I don't know if we call them bit bugs or what we call them. And there's nothing wrong with that. And I have no problem owning Bitcoin when it's going from lower left to upper right. But man, it is a
Are they back out full force?
Oh, it's an entrenched group.
They're probably pretty happy these days.
I mean, there's even people out there who are saying you can't buy Ethereum. That's how Bitcoin they are. I don't know.
Oh.
I'm pretty open-minded when it comes to assets. I don't really care what the name of it is or what its protocol or what chain it's on. If it's on the New York Stock Exchange chain, if it's on the Bitcoin, blockchain, doesn't matter to me. As long as it has the ability to protect purchasing power and move from lower left to upper right, I'm good with it. But man, I tell you, people are all about, you can't like anything but Bitcoin, Ian. That's the rules. So I'm going to call them the new gold bugs. Like that, we know gold investors are like that. Like it's always about gold. It's always about gold. But right now, I get it. You look at a chart of something like BTC USD versus S&P 500. It's back to levels that we haven't seen since March of 22. It's been an uptrend since the lows in late 22, early 23 on a relative basis. That's a good thing. But I don't think that chart, if it moves back to the other way, would ever change the sentiment of the ever Bitcoin holders, the hodlers.
No.
I could see a period in 10 years where Bitcoin has appreciated more than the stock market, but then subsequently corrects and the bit bugs will still be around. And it's going to be the same thing as what we had with gold bugs. They won't be able to resist owning that one thing when this is the best time for being able to invest. You can own so many things. You don't have to just own one, and you can own it in an ETF format. I mean,
True.
It's a great time to invest. I don't know why we have to be one thing versus the other. I don't know why it's got to be, I'm going to get controversial here. I don't know why it's got to be Israel or Hamas. Why can't it just be, let's not do war. Let's not do that.
I hear you.
So I kind of got on a tangent there. I'm pretty fired up only because the internet went down during this recording. Get me back on track. What else should we cover on this episode?
Credit spreads.
Okay. Credit spreads. What do we got there?
Credit spreads near their lows of the year. Back to where we were in September. So heading in the right direction. Got a little sketchy there in October, but definitely an area that has fixed itself. An area you would want to see fix itself.
It just means liquidity, right? There's just, if we got credit spreads tightening, that would be a measure of liquidity tightening. They're expanding now, or, not expanding, but dropping, which means there's more liquidity, where liquidity is fine. The cost of money is fine. And that's why we want to look at that instrument. So here we're labeling once again, high beta stocks versus low vol breaking new highs. Dow Jones holding onto its all-time highs, tech holding onto its new all-time highs, semis holding onto its new all-time highs. You got staples going out on new relative lows. You've got triple C credit spreads cooling off. I don't know what else people would want. You got home builders on a relative basis breaking out of a massive base. I'm not sure what else anybody wants. And this goes back to, are we in optimism or euphoria? Or are we still in skepticism in the John Templeton measurement of sentiment? I was impressed by the amount of people that really thought yesterday was the beginning of something big. Yesterday being a 1.5% downside, 1.5% move downside.
A lot of people that think it's like a big reversal.
Yeah.
Could be.
And chances are we get a consolidation or some type of pullback that no one will want to buy, and then you should have been buying it, and it moves higher into a seasonal strong period here at the beginning of the year. Now, I don't know if we move as fast as we did in November, December. I don't know we move that fast in January. But I'm not here to tell the market what to do. It's on a move. One day doesn't make a trend. Yesterday was not a trend. It was just a one-day move. And here we're sitting on the 21st of December, the shortest daylight day of the year. So people can be excited. Yeah, people can be excited about that, going forward now through June 21st. Every day, a little bit more sunshine, a little bit more vitamin D for everybody. Everybody could be a little bit more happy. What else, Ian? What else should we cover before we wish everybody a very Merry Christmas and sign off? What else would you like to cover?
Ray, you said rate of change.
Yep.
Rate of change and rate of trend.
Yep.
Yeah.
We've got a change in rate of trend on microcaps that goes back to March of 22.
See that? Yeah.
And we've broken there. Now we're at an important horizontal level here.
I got to get above that 115.
Yeah, 115 level. You still got a declining to flat 200-day moving average. But if you're going to see this, if the thesis of a 2024 that sees a catch-up trade or a correlation of one where you see small microcaps outperform the S&P, you need to see microcaps IWC above 115. You need to see IWM small caps above 200. It's really that simple. We don't need to overcomplicate this. Otherwise, the market is still dictated by the largest generals on the battlefield, your your Metas, your Apple, your Microsoft, those type of names continue to lead. Definitely possible. But before we sign off, I always want to give some tribute to the ETF that supports this podcast. That's the Adaptive Select ETF, ADPV, which is listed on the NYSE under ticker ADPV. Helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal, distributed by Quasar Distributors, LLC. Thanks for letting me highlight that. Ian, where do you hide the presents? I'm assuming that Connor's not listening to this episode, or should we not discuss that? Because maybe he's going to listen to some of these when he's like 10 or maybe a little younger and still wonder. We don't want to divulge that information.
I mean, it's a non-zero chance, but I think we'll be fine. Mine are in my office.
Okay. And we're set up. We're ready. We're ready for the weekend.
Yeah, pretty ready.
Okay.
Still need to wrap my wife's present and my mother's.
Yep. I'm still in the process of acquiring our family Christmas, which isn't until the week following, family member, and then wrapping up the pieces for who I have for my wife's side. But that's okay. There's deadlines for a reason. We're okay with that.
Yep.
All right. Anything else you want to touch base on before we
I don't
go join our market call? Thanks for battling through this one, Ian. I know we had some technical difficulties. I don't know what the finished product would look like, but we do thank those who do the editing for this. You guys do a fantastic job. You always make us sound so good. And so hopefully you can make some type of casserole out of this mincemeat with the internet going down and things like that. And those who are listening, we really appreciate it. If you like these and want us to continue to do that, make sure you share it. Make sure you give us a high ranking. And most of all, we hope you have a very Merry Christmas, and we'll see you guys soon.
Merry Christmas.